Hey, it's Tom here and welcome back to the channel. Now this is going to be the first Q&A video of 2022. I generally try and do these videos about once a month on the channel, and yesterday I put up a community post here on YouTube to collect your questions for this video, and I've got lots of questions and lots of really good questions. So in this video I'm basically going to start from the beginning, whoever put the question there first on the community post, and kind of work through as many as I can. And if you want to ask a question for a future video, basically just keep an eye out for my community posts page here on YouTube. That's where I always collect these questions for the Q&A videos. If you want to be notified of me putting up a new community post where I might be asking for those questions, just make sure you've got all your notifications turned on for the channel, and that way you'll be able to get in there quickly and ask a question for the next video. So that is the plan for this one, but before we get into that, we do have a sponsor for today's video, and this video is sponsored by Hedging. Hedging is the platform that I personally use for all of my US investing as a Kiwi based here in New Zealand. In 2022, Hedging are asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. Everyone's tomorrow looks different, whether you want to buy your first home, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hedging to help me make my plans a reality. If you want to get started investing with Hedging, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before June 30th, 2022. Okay, so let's get into the first question from Diraj. Have you considered investing in Japanese stocks? Yeah, I have never invested in a Japanese stock. I've said a few times on these Q&A videos now that I'm fairly open in terms of where I will invest. My preference would be to have most of my portfolio actually in New Zealand and Australia if possible. That's kind of the most tax efficient place for me to be investing my money in share markets, but I'm pretty open to basically going anywhere, and as it stands right now I just happen to have a big chunk of my portfolio in the US. That's just kind of where I've been finding opportunities, but I'm certainly open to investing in other countries. I guess there are a couple of challenges that come along with that. Obviously there's cultural differences that you may need to try and understand as well, but if the price is right on a particular business and you have a big margin of safety, that can insulate you from potentially making errors in other areas where you may not have been as susceptible to making those mistakes if the company was in your own country. So that's kind of my view on that. Next one is from Timothy William. I don't know if this is really a question, but he says SRG and Thor update. Sure. So I know I've been kind of promising a Seritage Growth Properties liquidation value or intrinsic value video. That will be the next video on the channel, so keep your eyes peeled for that. I've worked through basically all of the 170 properties to figure out comparable kind of sales values for Seritage. There's a couple of kind of final things I'm working through, so I don't know if I've mentioned it on the channel already, but I basically want to have kind of two different scenarios in that liquidation value approach that I'm doing. So the first one is going to be like a theoretical liquidation value. If we could sell all the properties tomorrow, pay off the debt and distribute that cash to shareholders, what would that value per share be? That's kind of the first thing I want to look at. The second thing I'm trying to look at is probably a more realistic scenario, which is Seritage continues with their redevelopment plans over the next few years, and there's going to be some capital expenditure and cash burn as they kind of work through that, and they're going to have to keep paying interest on this Berkshire debt and so on as they do that. And how much equity are we kind of left with in maybe 3, 4, 5 years time once we have some cash flowing properties and so on. They're kind of the two things that I'm trying to figure out. I'm pretty much there with most of the properties. It's the big kind of premier developments that I'm just trying to spend a little more time on and make sure I've got those or I'm as comfortable with those values as I can possibly be, because some of those properties are very large and move the needle for the value of Seritage quite significantly. So they're kind of the final details that I'm wrapping up with SRG, but next video on the channel will be that one. And in terms of Thor, I don't have too many updates on Thor. That is probably the business in my portfolio that I'm the most comfortable with owning, which is kind of strange to say because it is kind of a cyclical business. It has gone through big ups and downs in the past, and it will continue to do that in terms of the underlying earnings of the business. At the moment, they're going through a really big up, even though the stock price recently might not suggest that. So I'm really comfortable with Thor. It's a super well managed company, and the insiders, the founder and chairman of the board is still a massive shareholder in the company. He's actually been buying a little bit recently. I think he added maybe 1 or 2% to his existing position, which was interesting to see. If you just go on openinsider.com and look up Thor Industries, you'll be able to see that. So yeah, if it got cheap enough, I might buy more of it. I don't think it's the position in my portfolio that will necessarily provide the highest returns, but if you can get it at the right price, then I think it's a pretty compelling investment personally, but not financial advice. Do your own work on these things, of course. So thanks for your question. Next one is from John. Yahoo Portfolio Manager and Google show the total accumulated interest on your shares over a number of years. To get your annualized rate of return, do you divide that number by the number of years? I feel thick asking, but I've not had my coffee yet. No, fair enough, John. That's actually not how that works, I guess. That will not help you calculate a compounded rate of growth in your portfolio. So if you have a 30% return over 3 years as an example, that does not mean you've made 10% a year, because if you made 10% a year, it would kind of compound. It's like your $100 would turn into 110, and then if you make a 10% gain on that, that would actually be an $11 sort of improvement in your portfolio. Hopefully that makes sense. So those compounded rates of return can be quite difficult to calculate, and apologies if this sounds like a shameless plug, but I genuinely do use ShareSite for this purpose. I can pull in all my trades from the brokers that I use, including Hatch, who are sponsoring this video, and it makes it really easy to track this exact number. And it's not just the capital growth in your portfolio that you want to understand. You'll also want to incorporate any currency fluctuations if you invest outside of your home country, and also any dividend income as well. It will incorporate all of that stuff and give you a compounded return in your portfolio over whichever time frame you select. So if you do want to check that out, link in the description, sharesite.com/investingwithtom. There's a free version you can use there forever if you have less than 10 holdings, or if you want to go for one of the premium options that will get you 4 months free off of an annual subscription. So the answer to your question, John, is no, that's not how you do it, but there are tools out there to help you. Next one is from Compound Wealth Tree. Any portfolio updates, Tom? Yeah, I typically don't share my sort of full portfolio or anything on the channel here. Maybe I'll do that at some point, but no major changes to report. I was sort of setting out my goals for 2022 a few weeks back, and one of the things that I basically have on there every year is find one to two new investment opportunities, and that's kind of the plan again. I tend to just, use a punch card type approach, very Buffett style, and hopefully we have good results come out of that over time. So I'm fairly inactive in terms of adding new positions, even more inactive in terms of selling. So no big changes to report. Next one is from Curbs. Would you ever consider investing in a not yet profitable company if in researching it you find that they're developing a good mode, good management, etc., and you buy it with a reasonable price and a large margin of safety? Yes, I mean, Seritage Growth Properties that we were just talking about is a not profitable company. It's burning a lot of cash. They have a bunch of properties they need to basically sell off because they have no intentions to redevelop them, and they've got a lot of redevelopment work to do to get cash flow positive. So Seritage is one of them. I think you've basically outlined all of the things that you would want to look for in that case. Good management, a moat, reasonable price, and big margin of safety as a result of all of those things. That's kind of what you're looking for. There's obviously more uncertainty, I would say, with not yet profitable companies. It can sometimes be difficult to get a handle on what stabilized margins and so on might look like. So you do certainly need a big margin of safety, but I'm open to investing in a whole bunch of different situations, and that's potentially one of them if I think there's a good margin of safety. So appreciate your question. Next question is from Quan Wang. Apologies if I'm butchering your name. Is Berkshire or Daily Journal secretly buying Tencent? Yeah, I actually just got off a Zoom call with Warren and Charlie, and in fact they are buying. No, I'm kidding. So, yeah, no idea. It would be really interesting to if we ever saw that come out. I don't think we would actually see Berkshire Daily Journal buying Tencent show up on any sort of 13F because it's listed internationally, I guess, unless they bought like the over-the-counter ticker, which I don't think they would. But yeah, I'd be more surprised to see Berkshire buy it than Daily Journal. I can see why Daily Journal would potentially buy Tencent, obviously with Munger at the helm and having kind of Li Lu in his corner with China expertise as well. Berkshire seemed to be a bit more hesitant, but of course could be wrong about that. Maybe they've been buying it in Hong Kong very quietly, and we don't know. I'm not too sure. Thanks for your question. Next one is from Ryan. Are you hedging against inflation or the inevitable rise in interest rates? Do you think the increase in interest rates are already priced in for stock and bond markets? Yeah, that's a very macro question that I don't think I have the ability to answer, frankly, around do I think, rates are priced in and so on. That's what a lot of talking heads on CNBC will be 99% sure that they know the answer to oftentimes. But I try to show a little bit more humility than that when it comes to especially macro stuff. So who knows in terms of what future interest rates and so on are going to be. I've seen some very compelling arguments for why interest rates must go up, and I've seen some equally, maybe slightly less compelling arguments for why long-term, interest rates have to stay down. So I'm really not hedged, I would say, although I do have positions in my portfolio that may benefit from inflation, whether that's much higher commodity prices or whether that is inflating away some debt that a company might have. I guess they're not sort of traditional hedges, but I have kind of gone through that mental exercise of what happens to each of these companies that I've got in my portfolio if we go through inflationary periods or if we have higher interest rates. So that's kind of the process I've gone through, at least. In saying that, I did do a podcast maybe a month or so ago with Mitch and Cass Dole, who do have a very interesting hedge around interest rates. So if you want to go and check that out, head over to the Investing with Tom YouTube channel, or look it up on Spotify or Apple Podcasts or whichever podcast platform you use, and you should see that episode there if you're interested as well. Next question is from Love. Again, apologies if I have not pronounced your name correctly. Average price for Alibaba. Do you think delisting risk is there? Yeah, so I have videos on Alibaba delisting risk. If you want to go and get my full thoughts there, those are a few months old now, but I haven't had significant changes in my thought process there. Personally, my average price for Alibaba is around $200 a share, so I'm down a bit on that position at the moment. If it stays down and we get 12 months down the track or something, I may add to that position, but right now it's too big a percentage of my portfolio for me to be comfortable averaging down too much further. So I think the highest I bought it was maybe 215. Lowest I bought it might have been in the 160s, although the earlier buys were larger buys than the later lower priced ones. So average price falls pretty much right around 200. Next one is from After Dinner Investor, CarMax or Carvana. So what Jason, After Dinner Investor, is getting at here is that Rob Vinal actually recently bought Carvana. If you don't follow Rob Vinal already, he's a fund manager from Europe, I think he's based in. And he has compounded his fund at about 19% per year. He's got a pretty good track record, runs a concentrated, value-oriented portfolio. I believe his fund's actually called something along the lines of the Business Owners Fund. So that gives you a little clue about how he thinks about investing in public markets. And he just bought a new position in Carvana and released a shareholder letter with his thoughts on Carvana. So I haven't done a huge amount of work on either of those stocks. I have heard of Carvana plenty after seeing Cliff Sosin buy it a couple of years ago. and it's just a huge percentage of his portfolio now because it's gone up so much. And I probably always dismissed it as one of these, fast-growing high flyers that's now become really expensive because it's run up a lot. Possibly that's a mistake, and this is probably a good cue to do a little more digging on Carvana potentially, but I don't have a don't have a view worth sharing on it right now, at least. Next question is from Hamad. What is your SRG take currently? And if I want to buy Prosus, should I buy the stock in Europe or the one on the US exchange, Prosus TIKR? Which one do you own? I don't own Prosus. So I don't own Prosus or Tencent or Naspers. I initially was thinking of making kind of a basket bet or taking that approach when I was first looking into some of these Chinese businesses. I decided I thought I understood Alibaba the best out of all of them, so I chose to just invest in Alibaba, but not ruling it out. And I'm probably not the best person to answer your question on whether you should buy it in Europe or the US exchange. You're probably going to get similar results with each. I think the US exchange one may be an ADR, so there may be small, bank sponsor fees potentially built into there, which are kind of minor in the grand scheme, but I guess if you compound those out for a number of years, it might be worth considering. So I'm probably not the best one to answer that question for you, I am afraid, but I don't own Prosus to answer that question. And in terms of my take on SRG currently, like I say, next video on the channel will be around valuation. We did also recently have the CFO leave, which is probably more of a red flag than Mohnish selling a chunk of his SRG position to me personally. New CFO comes from, I believe it was called New York REIT. I'll put that exact REIT name up on the screen here, but he seems to have a bit of a history with liquidations actually, which is kind of interesting. I don't know whether that's we should read into that too much in terms of a potential strategy change at SRG, but it's something worth noting and certainly worth keeping an eye on. Next question here is from Tanner. Are you still bullish on A2? Do you think it's more of a 50-cent dollar or a long-term compounder? Also, thank you for such great content. Keep up the good work. Thank you very much, Tanner. In terms of A2, no changes to my position. It's kind of funny, with a lot of these stocks, we're trying to take a 3, 5, 10-year view potentially, and if there's movement in the stock up or down, in the following 6 months or year or something, you often get asked whether you're making any changes to it or anything. I don't know if that's what you're getting at here, Tanner, but my view really hasn't changed on A2 at this stage. Commodities are kind of ripping upwards, so it'd be interesting to see how that impacts A2's business. Milk, farmers are getting paid like record prices for milk here in New Zealand at the moment, so Fonterra and Synlait have both announced huge milk payouts compared to what they've paid in the past, so it'll be interesting to see how that flows through to A2's business. In terms of 50-cent dollar or long-term compounder, I mean, they've presented their kind of growth plans for the next few years, and by my maths it comes out at about a 10% or so compound annual growth rate for revenues. We'll have to see how that flows through to margins and so on, but I think it's the 50-cent dollar long-term compounder. Which one is it? I think they're in many ways kind of two sides of the same coin. I think I'm buying it at a discount to intrinsic value, hopefully at 50 cents on the dollar, kind of when I purchased in. Again, do your own work on these things, don't take my recommendation on that, but it's always nice if the intrinsic value is actually growing over time as well as sort of getting that discount. So I really don't know which one to classify it as. It's not my highest conviction investment, so if it shot up a lot I may be tempted to sell, but it all comes down to kind of opportunity set at the time and what sort of things are available. So thanks for your question. Next one here is from Andy K. Your thoughts on Mohnish trimming SRG? Current thoughts or updates on SRG would be fun to know. Yeah, so I've had a couple questions on that second part already, so I'll save that for the next video. But in terms of Mohnish selling SRG, I was kind of surprised by that. So I'll put the exact numbers up on the screen here, but Mohnish Pabrai, we got a 13G filing, I think it's called, out of Mohnish saying that he had sold a chunk of his Seritage Growth Properties position. Mohnish doesn't often trim, I would say. He generally kind of sells all or nothing as far as I've seen. I know he's trimmed stuff in the past, but that is kind of a rare move, and I don't know whether he's done that just because we've got visibility of what he's doing, because he has to immediately, more or less immediately, file these 13G filings rather than having to wait to the end of the quarter to do a 13F where we get more visibility. I don't know if that changes his selling philosophy potentially. But to me, I think it's probably just an opportunity cost thing. Potentially he's got better opportunities elsewhere that he would prefer to shift some capital to, rather than have it sitting in Seritage. I don't have a major view on that one, to be honest. Again, seeing super investors buy into stocks is super interesting, and I really enjoy following it. But you have to do your own work and build up your own level of conviction on these things. So I'll continue to keep an eye out for what Mohnish does, and also what Eddie Lampert does, because we did see some filings from him late last year around converting his operating partnership units and so on. But I'm not reading into it a huge amount, I must say. Let's do one last question here. So this one's from Chase Ricker. Is Berkshire worth 900 billion or so, 30 to 40% undervalued on a sum of the parts basis? Seems to be what Charlie, Warren, and Lee Lu think. Let me just pull up the market cap for Berkshire, actually. So the market cap for Berkshire right now is just a slither under about $700 billion. And last time I looked, Berkshire was trading north of about 1.3 times book. It may be closer to 1.4. Again, I'll put those exact numbers up on the screen here. That's always sort of the proxy I've used for intrinsic value for Berkshire. Just because of the way that accounting works with calculating book value, that ratio will go up over time in terms of where intrinsic value should sit, because you've got this treasury stock at cost item generated from share buybacks that actually technically pulls down the book value at Berkshire. So the price to book ratio that makes sense relative to intrinsic value will trend up over time. But I think if we go back 12 months or so, Berkshire was a little bit more of a no-brainer than I think it probably is now. Again, Buffett forever has used this 1.2 to 1.3 times book metric as a proxy for intrinsic value, and he's repurchased shares pretty aggressively over the past couple of years when it's kind of gotten below that, but it's kind of stretching out the top end of that range, or it might even be above that range now. So I think it's probably pretty appropriately priced, but as I've said a few times in this video already, be sure to do your own work on that topic. And as I've said in previous videos, I tend to default to Chris Bloomstrand on this topic. He knows Berkshire inside out. So if you look up Chris Bloomstrand or his fund, Semper Augustus is the name of his fund, he has very long shareholder letters which go into a lot of detail around calculating the intrinsic value for Berkshire. Is usually a staple of those letters, and he'll have a few tables that show you how intrinsic value has kind of grown over time. So he's much smarter than I am, and he'll give you some pretty good thoughts on that as well. Okay, so that is all the questions we have time for in this video. Thank you very much to everyone who did ask a question, and thank you all for watching the video. I really do appreciate it as well. If you're interested in the Hatch offer, I'll put the link up on the screen here for where you will need to go to get your free $20 top-up when you start a new Hatch account. Will also be linked down in the description as well. But that's it from me for this one, and I will see you in the next video. Cheers.